Hello everyone. We are done with the primary trend. Today we are going to speak about the secondary trend. Secondary trend is nothing but adjustment trend. So sometimes the stock prices are overvalued and sometimes the stock prices are undervalued. So this undervaluation and the overvaluation is adjusted in the secondary trend. So this is necessary to identify the secondary trend too. Because the market fluctuation what is there, sometimes that is the effect of the secondary trend. So how to identify the undervaluation and overvaluation? So that one we are going to understand in moving averages. If the closing price of the day is more than the 14 days average or the 21 days average, then that stock is treated as overvalued, and if the closing price of the day is less than 14 days or the 21 days, then that particular stock is treated as undervalued. So here in the secondary data itself, bullish type of trend is there and the bearish type of trend is also there. Here you can see the prices of the stock is increasing, and that increase is the effect of adjustment of the undervalued stocks. Okay, if the stocks are undervalued, in the next day the stocks will be adjusted. So that adjustment will be in 33.33 percentage to 66.66 percentage. So that is 1/3 of the stock or 2/3 of the stock prices may be adjusted. So this is the bullish type of the secondary trend, and here comes the bearish type of the secondary trend. So if the stocks are overvalued, then the stocks prices should be reduced. So here you can see the reduction. This fluctuation what you can see here is maybe a 33% or 60%. So 33% to 60% in between, this fluctuation will be there in the market prices. So identifying the secondary trend is also important because of the overvaluation and the undervaluation. Sometimes the prices will be adjusted in next days. Okay, so this is about the secondary trend. So here is the third type of trend, that is a minor trend. So this is nothing but day-to-day trend. So in minor trend, the stock prices of one particular day is considered, and in the stock market the regulatory authority is fixing some levels. So those levels are support level and the resistance level. So what is the support level? Support level is the minimum level where in that particular day the stock prices will not reduce from that particular price, and the resistance level is a limitation for the increase. So up to that particular price, up to resistance level, the prices can be increased. More than that, prices should not be increased. So this is what the restrictions from the stock market. So after understanding this support level and resistance level, we are going to understand the heads and shoulders of the charts. Okay, so these aspects are in the charts. After the candlesticks, we are going to understand the heads and shoulders. So these heads and shoulders will come in all type of the charts, whether that is a line chart or it is a bar chart or it is a candlesticks. Whichever may be the type, the head and shoulders will come. So this is also the part of the trends, but we are going to identify it in the charts. So head and shoulder chart patterns rises to the peak and subsequently declines. Okay, so here it is raised and subsequently declined. Then the price rises above the former peak. Price rises above the former peak. So from the left shoulder, it is increased to this particular point, and again it declines. Finally rises again, but not to the second peak. So finally once again it raises, but not up to this particular extent, but up to some extent, and once again it will decline. The neckline what you are seeing here is nothing but the support level. Less than that, the prices will not decrease. So this decrease, what you can see, is of the next day. So this support level and the resistance level are different for different days. Okay, so that is the decision of the regulator authority. Inverse head and shoulders, you can see here itself. The neckline is nothing but the resistance level. Up to this particular point only, the prices will increase. Okay, the left shoulder is there, head is there, right shoulder is there. Here, left shoulder price declines and moves higher. So price will declines and once again it moves higher, and once again it will declines for the greater extent and it moves once again higher. Once again, up to a smaller extent, it will decrease, and once again, that will increase. Fine. So this is what head and shoulders. There are two types of the heads and shoulders. One is positive head and shoulders. Second one is inverse head and shoulder. So in the positive head and shoulder, the neckline would be the support level, and in inverse head and shoulder, the neckline would be the resistance level. Likewise, we can identify the head and shoulders in each and every type of these stocks. Here is the candlesticks. Here also you can identify the head, you can identify the left shoulder, you can identify the right shoulder too. So this is about the investment analysis under the investment process. In coming classes, we are going to study the other 3 steps